Why is it that while the world stands on the brink of the most volatile geopolitical conflicts of the decade, gold, the safest haven in human history, is being dumped in a massive sell-off? There is a grim reality that experts rarely reveal to you. In a moment of pure panic, what people need isn't a store of value. What they need is cold, hard cash. Welcome to the dark side of the precious metals market in 2026. Right now, your newsfeed is likely a chaotic mix of war headlines, surging inflation data, and global instability. Logic dictates that gold and silver should be skyrocketing, but look at the charts. Instead of a moonshot, we're seeing red, or perhaps more frustratingly, a sideways drift that feels like a slow bleed. It's a complete divergence from what we've been taught to expect. To make sense of this madness, we're looking at a chilling forecast from Gareth Soloway, Chief Market Strategist at Verified Investing. He isn't talking about a minor pullback. He's warning of a massive flush, a technical washout that could catch millions of bulls off guard. But why now? Why, when the world seems to be falling apart, is the ultimate safety net fraying at the edges? To understand why a collapse scenario is actually feasible, we need to look at what the charts are actually telling us, rather than what we want to hear. Let's look at gold. For months, we've been tracking a specific range. We saw that major support at 4,400 to 4,300. After the top was put in, price flushed straight down, kissed that level, and bounced. But here is where the story gets concerning. Look at the bodies of the candles on that bounce. They didn't reach the previous all-time high. In technical analysis, we call this a lower high. It's a glaring sign of exhaustion. The bulls tried to push back, but they ran out of steam before they could even reclaim the peak. Now we're seeing what Gareth Soloway describes as a bearish consolidation. Imagine a runner who stops to catch their breath, but instead of standing tall, they are hunched over, gasping. That is what gold is doing right now. It's side-chopping, moving sideways after a big move down. To the untrained eye, sideways movement looks like stability. To a veteran trader, this is often the preamble to another leg down. If we connect the recent high pivots and draw a parallel line across the lows, a very clear picture emerges. We're trading inside a downward sloping channel. In the near term, the technicals aren't just neutral, they are objectively bearish. So where is the floor? Gareth points to two critical levels that should be on every investor's radar. First, there is 3,900. Why 3,900? Because that is a major pivot low from previous cycles. But the real target, the one that might cause a panic, is 3,500. To understand why 3,500 matters, you have to understand the concept of the scene of the crime. In technical analysis, when an asset breaks out of a long-term resistance zone, it almost always has to return to that exact breakout point to test it as new support. This is the retrace. If you look at the long-term gold chart, we had massive resistance for years. We finally broke out, but we never went back to say goodbye. We never retested that level. The 3,500 mark is that scene of the crime. It's the launching pad for the next massive move to all-time highs in 2027. But before we can get there, the market likely needs to flush out the weak hands, the investors who bought at the top out of FOMO and are now sitting on losses. This isn't just about gold, though. Look at silver. The pattern is almost identical, but perhaps even more aggressive. We've seen silver hitting key resistance around the $82 level and failing. Now it's forming a classic bearish flag. For Gareth, the buy zone for silver isn't here. It's down at the $49 to $54 range.
That is a significant drop from current levels, and it's a gap that most retail investors aren't prepared for. The problem here is psychological. Most people want instant gratification. They want the asset to go up the moment they buy it. But the market doesn't care about our desires. Natural human emotion makes us want to see a rally because that's where our money is invested. But the chart is our best chance at getting a clear picture of what is probable, not just what is possible. Probability tells us that support levels are like ice. The more times you hit them without a significant bounce, the thinner the ice gets. We have tested the $4,300 to $4,400 zone multiple times now. If that ice cracks, there is a lot of empty space below it before we hit the $3,900 safety net. This leads us to a vital question. If the technicals are this clear, why isn't everyone selling? Why is there still so much bullish chatter in the face of these lower highs? The answer isn't on the chart, it's in the plumbing of the global financial system. Because while the charts show us the where, the how and the why involve a much more dangerous phenomenon. In the next section, we have to talk about why even the most diamond-handed investors might be forced to sell their gold, even if they don't want to. We're diving into the hidden mechanics of the margin call and the liquidity trap. But why would they sell the best thing they own? Why dump an asset that is supposed to protect you when the world is on fire? The answer lies in a brutal rule of survival on Wall Street, the margin call. To understand the massive flush Gareth Soloway is warning about, we have to look past the charts and into the hidden plumbing of the financial system. Most retail investors believe that gold falls because people stop liking it. That's rarely the case in a crisis. In reality, gold often falls because it is the only thing left that still has a profit. Think about it. Imagine you are a large hedge fund or a high net worth trader. You have a massive portfolio, 60% in tech stocks, 20% in crypto, and 20% in physical gold. Suddenly, a geopolitical shock hits, or the Fed hikes rates unexpectedly. The stock market tanks. Your brokerage account flashes red. Suddenly, your phone rings. It's a margin call. Your broker demands millions of dollars in cash immediately to cover your losing stock positions. If you don't pay, they liquidate your entire account. Where do you get that cash? You can't sell your stocks, they're already down 30%, and selling now would mean locking in a devastating loss. You can't sell your crypto, the liquidity has dried up. So, you look at your gold. It's the only asset that has held its value or is still sitting on a 10% gain. You don't sell gold because you want to, you sell it because you have to. This is the liquidity trap. In a true market panic, gold acts as the global piggy bank. It is sold to pay for the sins of the rest of the portfolio. We're already seeing the early warning signs of this capital flight. According to recent data from the World Gold Council, global gold ETFs have been experiencing consistent net outflows. While the average person on X or YouTube is screaming, "Buy the dip," the big institutional money, the smart money, is quietly stepping toward the exit. They are raising cash, preparing for a period where liquidity will be more valuable than any yellow metal. This creates a domino effect. When the big players sell to cover their margins, the price drops. When the price drops, it hits the stop-loss orders of retail traders. Those orders trigger more selling, which drops the price further, hitting Gareth's key levels of $3,900 and eventually $3,500. It's a self-fulfilling prophecy of liquidation. But there's another layer to this. It's not just about forced selling, it's about opportunity cost. Right now, we're at a unique environment where U.S. Treasury yields are at multi-year highs. If you can get a 5% or 6% guaranteed return from the U.S. government just for holding cash, the zero yield of gold starts to look a lot less attractive to a fund manager who needs to show quarterly results. Reuters has been reporting on the sustained strength of the U.S. dollar, and as long as the dollar is king, gold remains under the guillotine. It's a simple inverse relationship. As the DXY dollar index climbs, the purchasing power needed to buy an ounce of gold shrinks, putting natural downward pressure on the price. So we have a perfect storm: forced selling from margin calls, institutional outflows from ETFs, and a dominant US dollar. When you combine these under-the-hood mechanics with the bearish consolidation patterns we saw on the charts, the massive flush doesn't just look possible, it looks inevitable. However, there is one more factor we haven't touched on yet. If the price is headed for $3,500, does that mean the gold mining industry is in trouble? Or is there a specific price floor where the giants of the industry will step in and stop the bleed? To find that answer, we have to look at the literal cost of pulling gold out of the ground.
We need to talk about the AISC, the all-in sustaining cost, and why the next few months might be a golden opportunity for those who know how to read the real math of the mines. If the price is headed toward $3,500, does that mean the gold mining industry is in trouble? Or is there a specific price floor where the giants of the industry will step in and stop the bleed? To find that answer, we have to look at the literal cost of pulling gold out of the ground. We need to talk about the AISC, the all-in sustaining cost. Many retail investors make the mistake of thinking that if gold drops, miners will stop selling to protect the price. In reality, the opposite is often true. In the world of industrial mining, cash flow is king. To understand the massive flush to $3,500, you have to realize that even at that level, the mining giants are still making a fortune. Currently, the average AISC for major global miners hovers between $1,800 and $2,000 per ounce. This figure includes everything: labor, fuel, taxes, and the capital needed to keep the mine running. Now, do the math. If gold is trading at $4,000 and drops to $3,500, a miner is still looking at a profit margin of roughly $1,500 per ounce. For these companies, $3,500 isn't a disaster. It's a dream price compared to the decade they spent struggling while gold was under $1,500. This creates a massive incentive for miners to hedge or sell their future production now to lock in these historic margins. When the big producers start selling their future supply to protect their profits, it adds an invisible layer of selling pressure that most retail traders never see on their 5-minute charts. They aren't holding for the moon, they are securing the survival of their corporations. But we can't talk about gold without talking about the 800-pound gorilla in the room, the Federal Reserve. As Reuters has consistently highlighted throughout 2026, the strength of the US dollar is acting like a gravity well for precious metals. Why hold an asset that pays no interest when US Treasuries are offering high guaranteed yields? The real interest rate, which is the interest rate minus inflation, is the true enemy of gold. When real rates are high, gold's luster fades. The Fed's current stance, combined with a higher-for-longer interest rate environment, has turned the US dollar into a vacuum cleaner, sucking liquidity out of commodities and into the greenbag. We are seeing a historic divergence. Normally, when geopolitical tensions rise, gold goes up. But in 2026, the risk-off trade has shifted. Instead of fleeing to Vang, institutional capital is fleeing to the dollar. It is perceived as more liquid, more stable, and, most importantly, it pays you to hold it. This is the macro trap. While the individual investor sees a war or a crisis and thinks, "I need to buy gold," the institutional desk sees a rising dollar and high yields and thinks, "I need to sell gold to buy bonds." However, this isn't just a story of doom and gloom. This macro pressure is exactly what creates the massive flush Gareth Soloway is talking about. It is a cleansing process. Markets need to overextend to the downside to wash out the speculative froth. When gold finally hits that 3,500 or 3,900 level, it won't just be a technical support on a screen. It will be a fundamental value zone where the cost of production meets extreme market pessimism. We also have to consider the Jerome Powell factor. As we look toward the end of his term, the market is already pricing in who might take his place. If the next Fed chair is more dovish, meaning they are more likely to print money and lower rates, gold's long-term outlook for 2027 becomes explosive. But we're not there yet. We're in the in-between. This is the period of maximum pain, where the dollar is king, the miners are chot lai, taking profits, and the charts are pointing toward a final sharp correction. Understanding this macro environment changes your perspective. You stop looking at a price drop as a failure of gold and start seeing it as a mechanical necessity. The giants aren't trying to save the price for you. They are playing a game of liquidity and interest rate differentials. So, if we know the where from the charts, the how from the margin calls, and the why from the macro cost of production, what is the final move for you, the investor? How do you survive the flush and position yourself for what Gareth Soloway calls the launching pad of 2027? It all comes down to one thing: disciplined patience. At the end of the day, you have to remember that a short-term price drop is not a death sentence for gold. In fact, it's a necessary purification. To reach the explosive heights projected for 2027, the market must first burn off the speculative excess and wash out those who are only here for a get-rich-quick scheme. Precious metals have not lost their intrinsic value. They have simply hit a wall of macro liquidity and institutional profit-taking. Success in this environment isn't about being the most optimistic person in the room. It's about buying at the right time and holding the right position. As Gareth Soloway's analysis suggests, the launching pad is being built right now, but it's located much lower than most people are willing to look. So, I have to ask, are you choosing to hold your gold regardless of the turbulence, or are you sitting on the sidelines waiting for that 3,500 level to flash on your screen? Perhaps you have a different bottom in mind. Drop your thoughts and your strategy in the comments below. In a market driven by panic and noise, your disciplined patience is your greatest asset. Don't forget to hit that subscribe button to track every move of this massive flush with us. We'll be here to decode the charts when the smoke finally clears. Thank you for watching, and I'll see you in the next deep dive.